Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. Today is the second trading day of week number 8. This is February 23rd, 2023. Second day because Monday was a holiday, but there's only 2 more trading days after this. So it's a short trading week. Markets open up after yesterday's horrible day. I don't know if you're going to see another snapback or another downturn. A lot of it depends on the geopolitical stuff and what happens. Obviously, there's a lot of chess playing when it comes to bullets and tanks and wars. I'm just going to show you what I'm doing. So before we get into trading today, if you're on Facebook and you want to see what I do, best place to see it is on Facebook group Investing 102, and I'll show you an example. I can post something like this. I did that 13 minutes ago, and you can see these are my trades for today already. And you can see that I already made about $170 today or so. And there's some more moves that I want to do today. And this video, it's the continuation of what I'm going to do with this particular trade. I'm going to talk about Marvell. But this is the best place to level up your investment knowledge. Join me, Investing 102 on Facebook group. So let's talk about this here, Marvell Technology. It is trading at about $66 a share. Let's just zoom out a little bit. It's been downtrending. That doesn't surprise anybody. The general market's been downtrending. 1 month chart is also downtrending. It did go back up and then it spiked down. If you look at the 6-month chart, nice run up. Right around Thanksgiving and Christmas, it peaked, and now the downtrend. Now, what I want to do is explain my current move. What I just did was this particular trade. So let's talk about the trade that I already did. I rode my cover call up and out. Basically, what that means is this. I'm going to summarize it real quick. You buy the close, the existing cover call, which is the August 1922. It's a $70 strike, and I closed that. On top of that, in the same trade, I then I sell to open another call, which is out in, you add another 5 months to it, that will bring you to January, and I did for $75. And I received a credit of $141. So what does that mean? What that means is potentially I'm adding $640 to my pocket if Marvell continues to run up. So what I'm saying is if this thing goes up to 75, I will make $640. So what I did was I moved the strike price from 70 to 75, add myself a potential to make money, but I received $140 for that bet. What that means is if this thing drops, I keep the $140, and that's awesome. Okay, so why is that important? What most people don't know is what is my cost basis? My cost basis is actually it's much cheaper than even here, and I'll show you real quick. Here you can see that my cost is under $27 for the 200 shares I own. So by moving this cover call above the price, I collect a premium. This one is now deep in the money by $20. So what I want to do is this concept of try to keep this one ahead of this and try to keep this one moving up. So I'm using some of the profit, this 140. I'm going to try to roll it into a new cover call for the second one. And what I mean by that is, so there are many ways to do it. I can do it by doing something like this, but I don't want to do that. I want to keep it in the same date because it's easy to understand if you use the same date. Let's hit the refresh. So what I want to do is basically change this $47 strike price. I already made profit because I bought the shares at 27, under 27. It's saying I have to sell my shares for 47. Why would I give it up for 47 if I can move it up, and let's say it will cost me $2.50, I gained another 50 cents by doing that. So the goal is for me to try to move this contract up without paying the full difference between the strike price. and now it becomes a fixed rate of return. And I'll show you what I mean. So let's try to get this deal done. I'm actually going to start under the bid. Under the mid. So I'm losing $200, but I'm gaining $300. This is a deep in the money cover call. And let's see if I can just get this done. And I'll show you the math afterwards. It's not going to go here. I'm going to move this up. I'm going to move it 10 cents at a time. And it looked like it went across. And let me show you a quick thing, and here you go. So I lost $210 to do this. So you're saying, why would I do something like this? Why would I lose $210 to move this up $3 in strike price? And I'll show you some of the math. So they both were the same date. I sell to open. And this is the new one. This is the $50 strike price. This is the 47 strike price. And if you look at what happened, if you want to look at the details, this is the cost of it. If you really want to know. So one of them, sell to open, I did that right. So this one cost me $22.76. This was a credit. This one is the 86, and this is the debit. So this is why I lost $210, or it cost me $210, okay? Why would I do this? So this is the part that I was going to explain. Let's show you some of the math here. So it cost me $210 today, but I gained $300. So what does that mean? If the net difference is $300, which makes sense. It's the difference between here and here, right? If you do the 50 minus, it's a $3 move or $300 gain. But if it costs you $210 to reap that, so what does that mean? What is the true profit? So you're only really gaining the difference between here and here. Whoops, I did that wrong. So the 90 is the net difference, which means if you divide this by the cost, think about this as I just invested, think about you're investing $210 to get the total of $300, which is the $90 profit. So if you do the math, I know it looks strange, but people don't think that's how it works, but it does. If I did nothing, I lose my shares at $47. So I receive $4,700. By adding another $210, you get the shares at $5,000, the 100 shares. So the difference is I just added, I spent $210 to make the $300, but you really want to look at the difference. So what I'm saying is if you look at the percentage, it's saying $90 divided by the 210. So I made 46% of this. Now, in theory, you're not really making, right? You're only making $90 difference. Now, some people like to look at it from a standpoint of, well, what are you really making? It's the 90 divided by the $5,000. And so this is what people look at. Well, what's really the difference? I'm making 1.8%. The $90 is what I'm making, and if you divide it by the share price, it will be a $50 share price, so that's what you're really making. So I'm making really 1.8% of my money back. So let's try to explain this in a different way. If you just do some simple math, there's many ways to look at it. Here's one way of looking at it. If I did nothing, I get $4,700. My cost basis is $27. That puts my profit at, the percentage is 174. If you use the option where you rolled it up to a $50 strike price, you get $5,000. It's the $2,700 cost basis, but the $210 in cash. My percentage return is actually lower at 171. Now, why is that so? And this is the part that really confuses a lot of people. So I broke it down to make it even easier to see. If you did nothing, I ended it In the future, I get the 4,700. My cost basis is, let's assume it's 27. Remember, my actual cost basis is actually less than that. It was 26 and change, but to make the math easy, so the profit is a simple formula. You just subtract, and it's a $2,000 profit. And if you just do the simple math here, it's 74% profit, which makes sense because it should line up here. Now, if I added the 210 and you only make $90, when you divide this total number up, it makes it look like you made less money. It's 71%. But look at the number. The share number, there is a difference. It's a $90 difference, right? We all know that. You can see that. So the $90 difference, but the difference here is a 210, which makes sense. We see that too. But if you do the math here, between doing nothing and adding an extra step, you see, this is why this is like the weighted average of the original trade. So yes, it looks like it will bring the average down because it actually does. But from a share math point of view, this $90 came out of nowhere, but it really didn't come out of nowhere. It came from the extra 210 that I put in to get the 90. And if you look at the math, this is why if you look at the 210, I only generated $90 profit from this 210, hence a 42% on that one. But if you look at it as a complete trade, yes, it brings it down. But you know what? I can't get the shares at $27 anymore. So you got to think about the moves that I do today. Because remember, if you did nothing, I can always tell people in both, hey, I got 74% return. By telling you, hey, I did this extra move, I made 71. It makes it look like you did worse. And that's not really true. What I did was, what I care about is, at the end of the day, I care about, can I still make more money? And remember, this is a shared thing unless the stock drops below 50. Now, I want to make it even more complicated. Don't forget that I did step one. This trade here paid me $141. So I'm using some of this premium to pay for this cost. And that's the part that really gets confusing, because what I'm trying to do is explain that I'm protecting myself in both ways. If the shares continue to run up, let's say to $71, $72, $73, by doing this part of the trade makes sense. I'm adding more upside value on my cover call for this one, and I collected a premium, and if the stock goes up, I add it, right? You don't really add more upside. You just capture the $3 difference by paying the $210, but I reap the $90 profit no matter what. All right, that's sort of what you're getting. This is a fixed bond because you sort of know where this is going to end. Not in theory, but you, right? If it stays above $50, you know that this is going to pan out. This 210 will return me $90 profit, 42% rate of return. In theory, but it's really not, right? And now, if the shares linger, let's say between $40 or $50 and under 74, it's still a good trade. You see, this is why it gets really confusing, because I have two different cover calls at two different prices. If I did nothing, I'll make money on both, because again, my cost basis is $27 per 100 share that I have 200 shares, but I'm trying to put more money in my pocket regardless if the price is going up or down. Now, I've created other videos. This is why I don't do a lot of buy rights. I like doing cover calls on shares that I already own and that are already profitable. And then what you're doing is you can do cover calls in many different ways. A lot of people use cover calls in a buy right situation. They look at it and say, and I'll show you what I mean real quick. I'm going to buy the shares today, and then I'll sell the cover call for $68. And they'll make the $1.50 on the difference between the strike price and the premium. The problem with that strategy is, what happened if Marvell finishes this week or next week or between now and whenever your options expire? What if this thing is downtrending? Just like if you look at this chart here. This was downtrending. Your cover call strategy is really horrible. It didn't really work. See, I made money on the way up, because my shares are $27. And remember, let's show you the 1-year chart. You see, I made money on the way up by collecting premiums on the covered call. And then I'm trying to make money on the way down. Even when this thing's adjusting, I still want to make one covered call above it. And then I can do another one by rolling it up and try to catch up to the market price. So it's kind of a strange thing to look at. It did reduce my buying power. I don't want to make you think that money came out of nowhere. It actually reduced my buying power because I collected 141. I spent 210. So it took buying power away from me. But what I try to do is position it so that if this thing goes up, I will make money. If it stays flat, I'll be in a really good position to make money again. If it goes down a little bit, I'll make money. Remember, the only time you really lose if this thing drops below $50. But then I can still write cover calls on both of them, and eventually you guys view it as, well, I'll lower my cost basis. But if I got it at $27, do you really think my cost basis is 27? It may be 22 or 23 or 24, whatever it may be. And if you zoom out a little bit, you can see $27 was down here. So if I've been writing cover calls on this all the way up, I don't know what my cost basis is. But that ain't even the point. The strategy that I'm trying to explain to you guys is cover calls doesn't have to be done on buy rights. They can be done on stuff that you own for a while. And you don't have to lose your shares. You don't have to just say let somebody take it away. No, you can roll it forward. You can still collect some premium. You can still move the strike price in your favor. And then you can do different things. I like using different strike prices on my cover calls so that if the market goes up, you're fine. If it goes down, you're fine. If it stays flat, you're fine. So this is an example where you see I have 2 cover calls at 2 different strike price. I did 2 different things and I'm going to make money on this. Hey, write a comment if you understand what I'm doing, if you like it. These are a little bit more advanced strategies. But again, hey, thanks again. Don't forget to like, comment, subscribe, share this with a friend. As always, let's do this together. Let's do this $1 at a time. Have a profitable day. Bye-bye.